You're watching Stockwatch this week. I'm Ntaoleng Lechela, and joining me to unpack your stock-related questions today via Zoom are Gary Booysen from Swiss and Ricus from PSG Hole and One Ruimsig. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Gents, thanks so much for your time today. Now let's start off by reflecting on markets action and the factors fueling what we've been seeing playing out. While a Fed rate cut has been priced in, there have been growing concerns about a more hawkish stance from the Bank of Japan. Gary, could this perhaps trigger a sell-off?
It certainly is something that's doing the rounds on social media. And if you look at the Japanese economy, it's by far, I think debt to GDP is around 263, 267%, somewhere around there. So obviously a very indebted nation that has incredibly low interest rates and has for a long time. So what that's done is it's prompted hedge funds and market participants to essentially borrow in very low cost yen and then go and invest that all over the world. The idea then is that if we see interest rates rising in Japan, you're going to see that trade starting to unwind. And that'll mean basically, market participants, hedge funds, whoever's been borrowing in yen and buying elsewhere in the world are going to essentially be margin called. There's going to be a forced selling there. They will have to sell off international assets to essentially repay the debt, or they've got to swallow much higher interest rates when they continue to roll their funding, and that could trigger unprecedented sell-off. That's kind of what the social media channels are telling you now. It's a difficult situation because it's unlikely. When I say it's unlikely, that you can understand the mechanism with which that's going to happen. But I mean, we did see ructions of this, fairly recently, and it quickly you saw the Japanese central bank backing out of it, and everything kind of normalizing. So central bankers, they work very closely together, and I think if there was global market disruption, there's going to be a coordinated central bank effort. So it does seem like the more likely scenario here is that they're going to allow the Japanese yen to continue to weaken, which is really the trend that we've seen over a long period of time. But certainly, I think it's one of the big concerns in financial markets at the moment, and I think it's been on our radar for probably 2-3 years now. That this is one of those things that hasn't been talked about that could potentially have a very large market impact. So it's something to keep an eye on. But I don't think we're quite at panic stations, sell all your equities just yet.
And I was about to say this feels like a case of deja vu because we've been here before, Ricus. Your thoughts around that and the spillover it could have in global equity markets?
Yeah, I completely agree with Gary. Basically, the yen carry trade is probably coming to an end or was almost at an end. And as Gary explained, once you don't have cheap yen to fund your other currency buys, then money flows out of whatever you've been invested back to Japan and you get a sell-off. I think it's concerning, but it's well telegraphed. So in that sense, the shock, so to speak, is already in the system to a certain extent. What remains, and as Gary has said, is how does Japan, and specifically the Bank of Japan and their new Prime Minister, handle the situation? And the easiest way is to have a weakening yen absorb some of that shock.
Let's move over to some company news now. Even the US M&A activity brewing, bids coming through for Warner Bros. Discovery. This has been a story that has really been hogging headlines recently. Paramount, Comcast, and most recently Netflix vying for those assets, and a lot of T's and C's attached, with some bidders gunning for the streaming business alone. This also happening when the group was trying to break up. Surely there's a lot of regulatory hurdles that come with also securing these assets, Ricus.
Yeah, and I think it's also a general trend is the consolidation of, shall we say, almost traditional media, if you can call streaming traditional, because that's what it's become. And And if the near past is any prediction of the future, it really depends on who carries the favor with Donald Trump and his administration, because the transactional nature of not only the political side of the U.S. administration, but also the governing bodies, which have had their, shall we say, old guard fired and replaced by people who are favorable to the administration and their transactional policies. So, yeah, it depends on who will provide the most gain to the administration for whatever deal goes through in the end.
And I didn't even think of it like that, because I mean, at the end of the day, he's the one moving around the strings at the top as well. Gary, your thoughts around that? A recent report said that Netflix is the leading bidder for those assets. Does this deal make sense for Netflix? I mean, right after that report was released overnight, Netflix's share price slipped into the red.
Yeah, well, generally, if you look at merger arbitrage trading, you generally you buy the company being acquired, you sell the company that is doing the acquiring, because you kind of almost assume that the acquiring company has to overpay, and that there's going to be, when the synergies are unlocked, you would benefit from the one that's being bought more so. But yeah, I think the transaction does make sense, and I mean, I understand that there is concern, around antitrust, and I mean, I 100% agree with Ricus, that the Trump administration is transactional, but they are a lot less tight on antitrust regulation than the Biden administration was. So when you look at a deal like this, personally, I think it will kind of pass almost the competition muster, because on the one hand, streaming is an incredibly competitive business at the moment, and yes, there'll be a consolidation between kind of what we'd call the number one streamer and the number two streamer, but at the same time, you've got Disney Plus, you've got obviously Amazon Prime, in the mix as well. You've got international competition. You've got YouTube, in Alphabet as well, and YouTube. Just to put it in context, YouTube is bigger than Netflix. Netflix might be the biggest independent streamer, but YouTube as a platform, as a content delivery platform, is massive. So it is a very, very competitive environment at the moment. And I mean, you can think about it not just from a corporate point of view, but as a consumer. I mean, how many different things can you watch? I mean, we're happy you're just watching this.
And how many different subscriptions can you have?
How many different subscriptions do you have to have? There's an immense amount of competition in this space. So, to block it over competition concerns, it seems to me like illogical, and the reason that it will be blocked is maybe they don't get their transaction right with the Trump administration. But like I said, I think that's probably unlikely, and the deal does make sense. I believe there's also a break clause in there as well.
Yes.
Should it not go through? But like I said, I haven't looked at the deal structure in a huge amount of detail. But just kind of partnering up to try and give also customers. If you think about it, when does antitrust really kick in? It's when you're going to get monopoly type pricing that harms consumers. But as you say, as a consumer, if I have to pay less subscription fees for more content and just have a single platform on which to stream on, I think that's actually a good thing. That's actually beneficial for consumers. And you want one place that you can go, and I think these streaming services, they're almost like telcos in a way, that they are natural monopolies as well. There's an economy of scale to them. You can actually reduce your costs further if you consolidate content libraries and subscriber bases, etc. It naturally lends itself to being a bigger organization. So I think some consolidation in the sector is probably not a bad thing in what is and we're just talking about streaming companies. If you talk about entertainment and you broaden that definition slightly to all the social media channels as well, and all the ways that we are now entertained, I really think it would be kind of difficult to argue the competition, argue antitrust around it. So I think it looks like a good deal. Like I said, I haven't looked at the underlying pricing specifically as to who should win and who should lose in the transaction, but at a broad level, strategically, it does seem to make sense.
And that brings us nicely into our next question on Vodacom, that it has just now taken over a controlling stake in Safaricom. That deal not likely to face as much regulatory hurdles. Just your thoughts around that deal, Ricus. I mean, Safaricom covers about 60% of the market in Kenya, also substantial coverage in Ethiopia as well. So that likely going to flow into Vodacom's top line.
Yeah, it makes sense to them broadening their scope because, as Gary just said, it being a sort of a utility, the bigger you can cast or the wider you can cast your net, the better it is for your revenue and in the end earnings, because you're not reinventing the wheel. What you are doing is just buying a bigger wagon. So I think they've had success in Egypt, and obviously they view Africa, specifically Kenya, as a good entry point, and they're just expanding business there. So in the end, it's not a new business; it's a business they know it's just a way of increasing revenue without being adventurous.
So diversifying revenue streams at a time, Gary, where the SA market is really tough, particularly the prepaid one.
Oh, absolutely. I mean, the South African market has been saturated in terms of SIM penetration for forever. And I think it's been one of the big challenges for Vodacom, and it's always been why MTN has been kind of my preferred telco stock, because MTN obviously has that huge footprint throughout Africa. It has far more customers than Vodacom, well, historically it did. I think MTN's now probably approaching 300 million subscribers, and Vodacom was trailing in subscriber numbers for a long time. Now, obviously, with the kind of consolidation in Egypt, Vodacom's almost taken a leaf out of MTN's playbook, and they're really spreading into Africa. So, kind of increasing their stake in Safaricom. I mean, it's well within what they want to do strategically, and I think the opportunity for telcos, in my opinion, was always the African continent. It's it's one of the Ricus called it a utility. It's if you can get that kind of first mover advantage, you become the number one or number two operator in that country. It's incredibly hard to displace you. I mean, we've obviously just had Cell C listing on the exchange recently as well, and we've seen how difficult it is to be kind of like the third operator. So, kind of making sure that you're kind of like the number one or two operator. You become a utility. You might not make supernormal profits, but you end up being a good compounder in portfolios longer term, because you supply your services. It's absolutely a utility in that people cannot live without connectivity, mobile phones, data, etc. So I think it's quite the opportunity was always Africa, in my opinion, and MTN, I think, did a better job. Now, it's just strange to me still that MTN and Vodacom in market cap terms are similar. They're similar prices, and yet MTN subscriber numbers is 1/3 bigger. I mean, we can look at the ARPUs and that and say, yes, they maybe don't extract as efficiently as Vodacom does, but in a utility type environment, you would expect that to almost equalize. So, I think a good move for Vodacom. They have to do it. So, great.
AVI Foods up for analysis. Just take us through the merits or otherwise for the counter, Ricus.
Well, it's also my stock pick for today.
Maybe let's give the question to Gary then.
Okay. AVI, like I said, AVI, I'm interested to hear. I'm having a look at AVI quickly because I haven't actually had a proper look at AVI previously for a long time. And AVI for me was always kind of perennially expensive, but just like a fantastic operator of a business. And I'm guessing the reason Ricus is going to look at the stock at the moment is because in earnings terms, it has become a lot cheaper than it was recently, like it has been for a long, long time. So, from a food producing point of view, I know they kind of normalized some of like their footwear apparel stuff.
Yes.
I think they closed down Green Cross, got rid of that. But from a food producer and kind of branded products, food and beverage company, I think inputs have also kind of moderated after what has been a very difficult period. If you look at kind of like Safex maize prices, you look at like a lot of the soft commodity inputs that go into these things. That's helped to reduce kind of food price inflation a little bit and allowed some of these businesses like AVI just to increase margins. And as I said, I'm actually like a little bit shocked looking at the forward expectations on AVI's PE. It does look a lot cheaper than it has been in a while, and yeah, maybe an entry opportunity. But I'm sure Ricus is going to tell us more in his stock pick.
Yeah. And I mean, the food producers have been doing quite well. You look at the past few earnings from the likes of a Premier, a Tiger Brands, really doing well. Just sticking with those food producers, then Ricus, and putting them up against the big grocers. I read a report yesterday citing that private label brands are losing ground. Their share of the fast-moving consumer goods market dropped to 17.6% from just over 18%. Now, I know that's not a big move, but I mean, it was just yesterday we were talking about the rise of these private labels and investments grocers are making towards those brands.
Yes, I mean, it is a trend, and it's always, I think, just broadly thinking about it, brand loyalty versus price.
Yeah.
And I think a lot of brands, just taking it worldwide and also locally to a certain extent, where companies have relied on the brand name rather than concentrating on what the consumer actually wants. Tiger Brands is a perfect example of somebody who realized that almost too late and has had to work very hard to turn around their business. If you take a look at those trends, I think it's basically your older type of brand company having to reinvent themselves in order to maintain that brand quality. One can even see it in things like the luxury sector, where all of a sudden you get your old, shall we say, European luxury brands all of a sudden realizing, but there are, it's not as if you've got a Chinese retailer with a European luxury sector. They're in danger of being a Chinese luxury sector with a European section. So even in fashion, things like LVMH, they have to go and say, well, what did we used to stand for? What is that quality that was associated with the brand? And we should really be concentrating on maintaining that rather than just on having a brand with a cheap input cost.
Let's move over to Novo Nordisk, right? Gary, is Novo a buy at these levels? Of course, it's way off its previous highs.
Yeah, it's a good question, and I personally don't own it at the moment, but I've actually been looking at picking it up. So I mean, Novo Nordisk, it's an interesting business. So of course, their major, I suppose, blockbuster win recently as a pharmaceutical company has been Ozempic/Wegovy. So Ozempic is the diabetes version of the molecule. It's marketed as the diabetes treatment, whereas Wegovy is the exact same model, but obviously the GLP-1 drug that's marketed for weight loss. And obviously everyone became very excited about this a couple of years ago. We saw the stock price going absolutely berserk. I mean, to the extent where, I mean, I know even at the business, clinical trials couldn't continue because they were running short of literally the injector modules that were being sold because they just couldn't keep up with demand. The demand was so off the charts. Now, if you compare that drug to something like Mounjaro, which is the Eli Lilly version, Mounjaro has shown a little bit better, I suppose, a couple more effective with slightly less side effects. I mean, these things do change from time to time, and I think that has kind of taken some of the shine off the share price. They are also going through like a huge round of retrenchments at the moment. So I think they're retrenching around 11% of their staff, globally, but half of that is coming through from Denmark. And from a shareholder perspective, that often is the time to go and buy a stock because it's a company that's right sizing, with the ramp up of Wegovy and Ozempic. they took on a lot of new people, a lot of new roles were created. Those roles now almost have to be unwound. And I think, if you look at it and the way they're going about it, it's probably going to be a lot leaner, a lot more efficient company, in the next couple of years. And it's really just trying to pick your entry point. I mean, it's absolutely vital to the Danish economy. So, when Novo Nordisk, when they release earnings, you actually see a change in the Danish kroner, because it's that central to Denmark. It's that large a business. So, I like it. I do like it. It's not particularly expensive. It's obviously, down, call it almost 50% for the year. And the only reason I wouldn't say dive into it right now is that there's no real, from a market side, there's no real catalyst that's saying stock price is going to turn around in the short term. But if you've got a 5-year, 10-year time horizon, I don't think you're going to be disappointed in kind of like Danish-based but multinational pharmaceutical group.
So a tough spot at the moment, but likely to improve moving forward. Are you seeing value in Novo Nordisk, Ricus, or would you rather go with the likes of an Eli Lilly or even Pfizer with its recent acquisition of Matsera?
Yeah, my preferred narrative is still Eli Lilly. So I would have that as the as the core if I want to be on that side. If I want to be in pharmaceuticals. But Gary is quite correct. Novo Nordisk is at an interesting price point. It's back to where it was start of 2022. So it's given back all the gains it's had. Since the advent of these diet drugs, if you want to call it that. So I think the company, in a certain sense, got lucky, and the story just ran away with management. Even if one takes a look at something as simple as not licensing, not extending their license in Canada. So there's a lot of organizational work to be done.
Yeah.
And I think market traders or investors will take a look at this and say, well, okay, is that reorganization now taking, is it actually gaining ground? We don't know that yet. So I would tend to not buy a share that's still in a very much confirmed downtrend. But that being said, they are at that level where it might start finding support, might start trading sideways. And if it does start ticking up, you are going to pick up a very big drug company at a very cheap price.
Okay, I love it when analysts have differing views. Gives viewers options. Let's get into your stock picks. Then I'll start with you, Ricus. AVI.
Yeah, Gary has basically said a lot of the things I was going to say about AVI, and its quality, consistency of earnings. As far as costs are concerned, I think far less onerous than it has been over the past year or two, specifically with what looks like a pretty decent planting season. So at least the one aspect of the cost inputs will be far less damaging than it's been in the past. They are sitting historically, we've compared historically at a pretty decent price, and it hasn't been in a long time. And more than that, that whole sector, whether it be Tiger Brands or any of the others, I think there's a positive outlook on this sector as well, which will also add to the positive price momentum. And I see a target price of around about 115 Rand plus a dividend of around about 5%. That still is a 15% gain from current prices.
And what about you, Gary? Where are you seeing value at the moment?
Yeah, so I'm going to go with one of our. So really for me, it's retail and banks are two sectors that I think in the South African market are looking very, very interesting. So this actual stock pick I'm going to go with today is going to be Mr. Price. So we had interims out recently. I mean, revenue up 5.4%. You know, like-for-like sales also up around 5.3%. Earnings per share up 6.5%. So nothing really to write home about. But you did get a little bit of a kicker in the share price as those results were released. It was a lot better than I think people were expecting. Now, yes, they kind of highlighted the South African consumer is under a lot of pressure at the moment. You know, times are obviously tough in the local economy. I mean, even for an omni-channel value retailer like Mr. Price. But I do think that we're starting to feel the ship turning in South Africa, and we can feel it. I mean, load shedding seems to be something in the past. I don't know whether it's going to come back or not, but that's a massive kind of benefit for so many businesses and so many consumers. We're off the grey listing at the moment. We've had our credit rating at S&P Global raised by 1 notch. We've had our inflation target, you know, reduced, sure, but I mean, we have our inflation under control at the moment. This probably means lower interest rates longer term. Our currency is pretty strong. So looking at our local businesses, and Mr. Price is one of them, which is kind of down at a technical level. It's not particularly expensive for a South African retailer. If I look at it, you know, if we look at like a 1 year forward at the moment, you're probably trading, you know, 13.5 times earnings, well, expected earnings at least. And if we do see the narrative around South African investment coming a little bit better, typically the retailers benefit from international foreign portfolio flows. So the foreigners come in and buy up our stocks, the likes of Clicks and Mr. Price and, you know, Shoprite, and all of them will kind of probably command higher multiples as well, even if you don't necessarily see massive earnings increases. So that's it. So that's kind of Mr. Price, but like I said, also financials as well. If you look at something like an Absa Bank, I'm going to give you 2 stock picks today. Look at Absa Bank. I mean, this is trading on kind of 6 times earnings with or call it 7 times earnings with a dividend yield of 7% for one of our major banks. It's just too cheap. I think SA Inc. in general is maybe a little bit cheap at the moment, and there could potentially be a re-rating higher. And that's why I'm going Mr. Price, Absa, maybe Nedbank.
Gary. One stock pick. SA Inc. basically. All right, gents.
SA Inc. is my stock pick.
Yes, let's leave it there. Thank you so much for joining me today. Gary Booysen from Rand Swiss and Ricus from PSG Hole in One Ruimsig. And that's all from Stockwatch. But do stay tuned for lots more coming up right here on Business Day TV.